If you're like most working Americans, you've never stopped to carefully review your official Social Security earnings record, and this incredibly common, harmless-seeming mistake can end up costing you massive amounts of retirement money over your lifetime. Tens of thousands of dollars in future Social Security benefits get permanently lost every single year for ordinary hardworking people, simply because one single year of wages was missing, underreported, or incorrectly logged as zero on their official SSA work history. The worst part is this: nearly every worker assumes their Social Security retirement benefit calculation is automatic, accurate, and fully updated by the government every single year. Most people believe their final retirement check is based on their last few years of work, their highest salary late in their career, or a standard formula that perfectly accounts for every paycheck they've ever earned and taxed throughout their entire working life. This is one of the biggest, most expensive myths in the entire American retirement system, and it costs average workers huge sums of money they rightfully earned. The truth is, your Social Security monthly benefit is not based on your final salary, your best-paying job right before retirement, or your most recent employment years. Your benefit is calculated exclusively from your 35 highest inflation-adjusted earning years across your entire career, and every single missing or underreported year directly damages your lifelong average income. Even if you physically worked a full calendar year, clocked regular hours, worked overtime, juggled multiple part-time and full-time positions, ran a self-employed business, and paid every single Social Security payroll tax required by federal law, a simple administrative filing error from your employer or a tax reporting mistake can erase that entire year from your official record. Once that year is logged as zero earnings or artificially low earnings in the SSA database, the system permanently lowers your average indexed monthly earnings, which is the foundational formula number that determines exactly how much money you receive every month in retirement for the rest of your life. These errors do not fix themselves, the government does not notify you of missing wages, and there is no automatic system audit to correct your record. Every single fix falls entirely on you as the account holder, and if you never check your earnings history, you will lock in a reduced retirement benefit forever. Today, we cover every single detail you need to know to fully understand how the 35-year Social Security calculation rule works, why missing earnings years are so financially destructive, exactly which workers are most at risk of having incorrect records, how to spot errors on your official statement, what official documentation you need to fix mistakes, how to submit formal corrections to the SSA, and how to strategically protect and maximize your future retirement income. The core rule that governs your entire Social Security retirement benefit is the 35-year highest eligible earnings calculation. The Social Security Administration pulls every taxable work year you have ever logged in your lifetime, adjusts every single year's earnings for historical inflation to balance for decades of rising prices and purchasing power changes, sorts all adjusted annual earnings from your highest earning years down to your lowest earning years, and selects your top 35 highest years to calculate your lifetime average monthly income. That final average number is the sole metric used to generate your permanent monthly Social Security retirement benefit amount. If you have worked longer than 35 years in your career, your lowest earning years automatically drop out of the formula and get replaced by your higher earning years, which is why continuing to work later in life with a higher salary can raise your future monthly benefits. However, if your total documented work history is less than 35 years, the SSA does not ignore those empty years. Instead, the system fills every single unfilled year with a $0 earnings placeholder to complete the mandatory 35-year calculation pool. This zero averaging mechanism is the reason one single missing work year can destroy thousands of dollars in your long-term retirement income. The algorithm does not differentiate between a year you intentionally took off from work and a year your employer failed to file your payroll taxes correctly. It only sees the numbers in its database, and zero earnings will always drag down your overall career average. To fully understand how damaging this error truly is, picture working an entire calendar year consistently. You show up to work every week, you cover household expenses with your income, you work extra shifts to provide for your family, you fulfill every tax obligation, and you contribute to the Social Security system, expecting to build future retirement credit. Yet due to a simple administrative oversight, that entire year of hard work disappears from your federal work record. For Social Security calculation purposes, that year never happened, and your lifetime average income is permanently reduced as a result. This is not about trying to cheat the system or gain unearned benefits. This is simply about protecting the retirement income you have already legally earned, paid for, and contributed toward throughout your entire professional career. Verifying and correcting your SSA earnings record is basic financial self-protection for your future retirement security. The level of financial damage caused by a missing year depends entirely on how many total documented working years you have in your official record. If you have a long, stable career spanning 40, 45, or even 50 years of consistent documented employment, one single missing or low-earning year from an early entry-level job or part-time youth work will rarely impact your final benefit. Your surplus of high-earning adult career years will easily offset that single low or blank entry, and the system will simply exclude that year when selecting your top 35 earnings. But if you have a shorter career with only 30, 32, or 34 fully documented working years, every single entry in your 35-year calculation pool is critical and irreplaceable. A single zero or severely underreported year cannot be offset by extra high-earning years, which means that one tiny administrative mistake will directly lower your lifetime income average and permanently shrink your monthly retirement payout for every year you collect benefits. Certain groups of workers face drastically higher risk of record errors and must prioritize an immediate full earnings audit. Self-employed individuals who file annual Schedule C business income face some of the highest error rates because their Social Security work credits rely entirely on accurate self-reported tax filings, which are far more prone to human error, tax preparer mistakes, inconsistent annual reporting, and missed documentation compared to standard W-2 employment. Workers who have had dozens of different employers throughout their career, especially employees of small local businesses, family-owned shops, and independent companies with outdated, underfunded payroll systems, regularly experience misfiled, mismatched, or completely lost wage records. Anyone who has legally changed their name due to marriage, divorce, or personal name adjustment faces massive risk of detached wage records, because even minor spelling differences between employer W-2 filings and your official SSA profile can cause entire years of wages to fail, attaching to your account. Workers who've been employed by companies that shut down, relocated out of state, restructured, or went bankrupt frequently lose official payroll archives, meaning those years of employment are never formally reported to the SSA. People who work seasonal jobs, temporary contract roles, cross-state employment, or multiple simultaneous part-time and full-time positions deal with fragmented payroll processing, which creates constant gaps and underreported earnings in federal databases. All of these extremely common career scenarios create hidden financial losses that compound decade after decade, and most workers never discover these errors until they are preparing to retire, when corrections become far more complicated. A clear side-by-side worker comparison perfectly illustrates how unfair, uncorrected record errors can be. Two workers with identical 35-year careers, identical working hours, identical tax payments, and identical job histories will receive different retirement benefits purely due to an administrative error. The first worker has a flawless, fully documented earnings record and receives the full monthly benefit they earned. The second worker works the exact same hours, pays the exact same taxes, and contributes equally to the system. But 1 year of employer payroll data was never filed. The SSA system logs this worker as having 34 working years plus 1 0 year, lowering their lifetime average and locking in permanently reduced monthly benefits. Two equal contributors receive unequal retirement outcomes through no fault of their own. This widespread problem exists not because of flawed Social Security policy, but because of massive public complacency. The average American automatically assumes all government records are precise and error-free, which is completely untrue. The SSA has no internal error detection software, no automatic payroll cross-check system, and no proactive review process for individual worker records. Every earnings entry in your profile comes solely from external employer submissions and IRS tax filings. If those filings are wrong, incomplete, or missing, the error remains in your record permanently, unless you personally find and fix it. Your annual Social Security statement is the most underutilized financial document in retirement planning. Almost everyone who views their statement only checks the estimated benefit amounts for age 62, full retirement age, or age 70, ignoring the far more important year-by-year itemized earnings history log. This chronological list of every annual wage entry is the exact data set used to calculate your lifelong retirement benefits. Yet almost no workers take the time to verify its accuracy. Auditing your earnings record is fast, completely free, and requires no advanced financial knowledge. All you need to do is log into your verified official My Social Security account through ssa.gov. Open your most current official Social Security statement and navigate directly to your full yearly earnings history. You can spot almost every error with 4 simple verification checks. First, scan thoroughly for any $0 earnings entries. $0 years are completely valid for periods of unemployment, schooling, disability, or workforce absence. But any 0 year where you actively worked full-time, part-time, self-employed, or multiple paying jobs is a confirmed error requiring immediate correction. Second, identify any years with unrealistically low earnings totals that do not match your verified work activity. A full year of consistent full-time employment should never show only a few $100 or $1,000 in recorded income. Any year with drastically underreported wages will actively lower your lifetime average. Third, carefully audit every single transition year in your career. Years involving employer switches, cross-state relocation, legal name changes, transitions from W-2 employment to self-employment, multiple concurrent jobs, company payroll system updates, and business closures are the most common years for filing errors. These transitional periods create administrative chaos for payroll departments and result in permanent, undetected record gaps. Fourth, prioritize your highest earning career years during your review. Errors in your peak earning years cause exponentially more financial damage than errors in low-income entry-level years. A missing low-income year is often replaced by higher earnings in your top 35 calculation pool, but a missing high-income year removes one of your most valuable calculation entries and permanently crushes your benefit average. Understanding which worker groups face elevated risk helps you determine how urgent your audit should be. Long-term employees of large corporate companies with standardized professional payroll systems have the lowest error risk, though occasional verification is still recommended. Self-employed workers face the highest risk due to self-reported tax documentation. Small business employees face high risk from outdated payroll systems and lost physical records over time. Workers who have changed their legal names frequently have detached wage entries. Multi-job workers deal with partial employer reporting gaps. Workers with fewer than 35 total documented working years cannot offset any 0 entries and suffer direct permanent benefit losses from every error. Workers within 5 to 10 years of retirement must fix all discrepancies before submitting benefit claims, as post-claim corrections face long administrative delays and often do not apply retroactively to your initial benefit calculation. Even current Social Security beneficiaries already receiving monthly checks can qualify for permanent benefit increases and eligible back pay by correcting past record errors. When you discover incorrect entries on your earnings record, you can absolutely fix them with official verifiable documentation. The SSA will never approve corrections based on personal memory, verbal testimony, handwritten notes, or personal estimates. Valid official evidence includes original or duplicate W-2 wage statements, complete federal income tax returns for the disputed year, sequential monthly pay stubs, official employer wage verification letters, union payroll archives, and any government-verified document linking your identity, tax year, employer information, and total annual eligible wages. Self-employed workers use filed federal tax returns, Schedule C business profit and loss loss forms, Schedule SE self-employment tax filings, and official tax payment records to prove correct earnings. If your personal copies of old tax and payroll documents are lost or destroyed, do not assume correction is impossible. You can retrieve official records by requesting IRS tax and wage transcripts, contacting former employers for duplicate payroll records, accessing archived tax preparer files, reviewing cloud-based tax filing history, examining historical bank deposit records, and checking state workforce employment databases. Official government archives almost always retain records long after personal copies disappear. When submitting corrections to the SSA, use clear, standardized language to avoid processing delays. Never submit vague complaints about low benefits. Instead, formally state that you have reviewed your Social Security earnings statement, identified missing or inaccurately recorded covered wages for specific tax years, and are requesting an official earnings record correction. Clearly list the problematic tax year, the incorrect amount currently on record, and your verified correct earnings total with supporting documentation attached. You can submit corrections securely through your online SSA portal, via the official SSA phone hotline, or by filing Form SSA 7008 for formal disputed wage claims. Always retain duplicate copies of all submitted documents and use certified mail for physical submissions to maintain a verifiable case trail. It is critical to understand SSA correction timelines and exceptions. The standard correction window expires 3 years, 3 months, and 15 days after a tax year ends. But limited formal exceptions exist for qualifying circumstances, so never automatically dismiss older errors as unfixable. Always confirm eligibility rules and required documentation with SSA representatives for every older disputed year. 2 primary error types affect your record: fully missing 0 earning years where no income is logged despite active employment, and severely underreported low earning years where income appears but is drastically lower than your verified actual wages. Self-employed workers must remember that only net taxable business income counts towards Social Security benefits, not gross business revenue, which is why official IRS documentation is mandatory for accurate corrections. While correcting errors is powerful, it is important to manage realistic expectations. Fixing a record mistake does not guarantee a specific dollar benefit increase, as final adjustments depend on whether the corrected year falls in your top 35 earnings. The gap between old and new earnings values, your total number of career years, and your current benefit claiming status. However, leaving verified errors uncorrected absolutely guarantees permanently reduced monthly benefits for every year you collect retirement income, creating massive cumulative losses over decades of retirement payouts. You can strategically boost future benefits and offset record gaps through intentional career planning. Workers with fewer than 35 documented years can replace 0 calculation placeholders by working additional eligible years to raise their lifetime average income. Workers with 35 or more documented years can replace old low-earning entries with new high-earning years to permanently upgrade their baseline benefit amount. Always balance career decisions with your personal health, family responsibilities, financial needs, tax liabilities, and Medicare premium costs, and never base retirement timing on guesswork about your past work history. A simple practical example demonstrates this strategy perfectly. If your official record contains 34 valid working years and 1 system-generated 0 year, retiring immediately locks that 0 into your lifetime average forever, permanently suppressing your monthly benefit. Working just 1 additional eligible year overwrites the 0 with real indexed earnings, lifts your overall career average, and creates a higher permanent retirement payout for life. Your complete 8-step earnings audit action plan is simple, free, and accessible for every worker. First, log into your official verified My Social Security account via ssa.gov. Second, open your most current official Social Security statement. Third, navigate to your full chronological yearly earnings history log. Fourth, scan and flag all $0 earnings entries. Fifth, document every 0 year where you confirm active eligible employment. Sixth, Highlight all years with unrealistically low recorded income inconsistent with your work history. 7th, cross-reference all suspicious years with your personal W-2s, tax returns, pay stubs, and archived financial records. 8th, compile all verified evidence and submit official SSA correction requests for every confirmed discrepancy. While completing your audit and corrections, remain vigilant against widespread Social Security scams targeting workers fixing earnings records. Fraudulent services frequently promise guaranteed benefit increases for upfront fees, claim special government access, or offer private record correction shortcuts. Legitimate SSA corrections never cost money, never require third-party intermediaries, and never guarantee specific benefit amounts before formal record review. Never share your SSA login credentials, social security number, or banking information with unsolicited callers, texts, or emails. All valid record corrections originate from your personal official SSA account and direct communication with verified SSA staff. The financial stakes of this simple audit cannot be overstated. Even a small monthly benefit reduction of $50 to $100 balloons into tens of thousands of dollars in lost retirement income over 20 to 30 years of benefit collection. A verified, error-free record gives you accurate retirement projections and complete planning confidence. Every month you delay correcting verified errors extends the period your benefits are calculated on flawed data, locking in lifelong financial losses. The SSA provides 0 proactive error checks, 0 automated notifications, and 0 official record reviews, placing full responsibility for record accuracy entirely on individual workers. You do not need to be a Social Security policy expert to protect your retirement future. You only need to carefully review your yearly earnings history, identify blank, zeroed, or artificially low earning years, and resolve discrepancies with official documentation. This simple process moves your retirement planning from risky guesswork to complete financial control. I encourage every working person to complete this full earnings record audit within 24 hours. After verifying your full work history, comment "Record verified" if every entry matches your actual career with 0 errors. If you discover suspicious incorrect years, only comment the specific calendar year to protect your private financial information. Your public comment can motivate other workers to complete this critical check before locking in permanent retirement benefit errors. Subscribe and enable notification alerts for plain language breakdowns of Social Security rules, Medicare policies, IRS tax regulations, and retirement planning strategies that protect ordinary workers from costly administrative mistakes. Share this comprehensive guide with every friend, family member, colleague, and acquaintance who is self-employed, works small business jobs, has changed legal names, juggles multiple jobs, or is actively preparing for retirement. A single missing earnings year seems like a minor paperwork detail, but once you understand how the Social Security calculation system works, you realize these hidden errors destroy lifelong retirement security. Auditing and correcting your earnings record lets you protect every dollar of the retirement income you have worked your entire career to earn, preserving your hard-earned benefits for your future retirement years.